Thanks for staying with us. Our next session is on the Nedgroup Investments Stable Fund managed by Forward Asset Management. The fund has the dual objective of delivering inflation-beating returns while also avoiding losses over rolling 12-month periods. Joining me now from Forward Asset Management is Rashaad Tayob. Rashaad, the objective of the fund is to not simply beat peers but to deliver inflation-beating returns while protecting investors from downside risk. Looking back over the last few years, do you think the market has underappreciated the importance of capital preservation?
So if you look at the objectives of the fund, it's twofold. It's to deliver that CPI plus 4 return, but also to protect capital. And I think we have done that successfully during very significant drawdowns. So if you look at the financial crisis, if you look at the COVID crash, we have not lost capital over a rolling 12 months. If you look at the longer term returns, we are above the CPI plus 4 as well as peers. But in the shorter term, we have lagged, and I think we'll talk about some of those headwinds that we faced in recent quarters.
And I think that, you mentioned that no negative rolling 12-month periods. That is quite remarkable because you're looking for upside while also protecting on the downside. How do you balance and maintain that downside protection while still ensuring the portfolio can participate when markets are rising?
So it starts with asset valuation. We're not running structured products or implementing hedges all the time, but it's about buying the right assets at the right price. If we have a portfolio which has assets at good valuations with good upside and minimal downside, we're doing our job, and combining those assets well in terms of making sure we're not exposed just to one factor. And I think that's a very dangerous area where you find funds can look like they're performing well, but it's all due to one underlying factor. So by diversifying across factors, across asset classes, that's helped us over the last 20 plus years in order to not have that negative return over a rolling 12 months. And it's something we aim to keep up going forward.
And certainly if you look at the longer term performance track record, you have delivered on those objectives. So well done in that. Speaking of asset classes, bonds, gold, inflation-linked assets were meaningful contributors, while offshore equities were detracted over the quarter. Was that largely a function of currency moves, equity market, or active positioning?
So if you look at the drivers over the last year, local assets were the biggest driver. You look at the bond position, it was nominal bonds, which we know had a great year last year. Inflation linkers, which we've been moving into, have performed well this year. So those have been big drivers. The other assets like commodities, that's our gold position over the last year has been a big driver. But if you look at the last quarter, you've seen a bit of a pullback. So it has been a bit of a detractor. On the foreign side, that's the area which admittedly hasn't really delivered. It's a combination of the relatively strong rand. Rand's been an outperformer, was really in the sweet spot in 2025. And then on the offshore side, it has been a difficult period in terms of a very narrow market. And I think we'll talk later about some of those factors which have come through and meant that the offshore side over the last year hasn't really delivered.
Definitely. You mentioned the rand as well, so we'll get stuck into that in a minute. Well, the fund's return explicitly tied to an inflation objective. A big theme today has been inflation amongst the other speakers. What do you think the market is currently getting wrong about SA inflation, especially under the sort of new SARB inflation model?
So we saw prints as low as 3% on SA inflation, and we saw the SARB implement this new target, which they had campaigned for a very long time. And unfortunately, just as they got that new target, a whole bunch of challenges came through, especially in terms of the war and the spike in the oil price. But our view was that inflationary pressures were building up even before the war had started. What I've got here is a chart of CPI goods and CPI services. And in blue, you see CPI services has been moving up from just below 4%, currently well into up at 4.7%, and that was moving higher even before the war started. You look at things like electricity prices, you look at where wage settlements are, you look at medical aid inflation. There were just a lot of underlying pressures. Rental inflation had started to build. So our view was that 3% was that we had got to, and the new target was due to specific factors at that point. A lot of things had to go right, but for South Africa, a 3% target is very aggressive, and I would argue quite unsustainable. That's part of the reason why we had been shifting more towards inflation-linked bonds, as the market had priced in 3% inflation, mission accomplished. They thought that the new target was a done deal. We weren't so sure, and that's why we've tilted very heavily into inflation-linked bonds.
Okay. And then, of course, going hand in hand with inflation is, of course, the rand, as you've touched on. which has been, I think, remarkably well behaved despite volatility and all the risks that we've seen, especially against the US dollar. Do you view current levels as justified?
So not only did inflation go right last year, but we also had the terms of trade. So we had gold and platinum rally while oil was down. That helped us from a current account deficit perspective into a surplus. We had the GNU beginning to work well. So the politics, the market got excited about the prospects of structural reform coming through. But we thought, especially by the end of last year, a lot of that good news is priced in, and especially so in the Rand. Our view, fair value on the Rand is around 1750 to 18. So at the moment, at around 1650, we think that the Rand is pricing in a lot of that good news from last year. And if we look at over the course of this year, much of that good news is already unwound, but the Rand is still quite strong. And you can see that in the performance on the right-hand side, the Rand versus emerging markets. We have far outperformed a lot of emerging markets. So from our perspective, having a good amount of offshore is quite a positive for the fund going forward, and we think the risk return on the Rand is more towards weakness.
Okay. And then coming back to another part, or big part of the fund, which is gold, right? And gold has an exceptional run, it's come off the boil, year to date. Is your view that the fundamentals remain intact? And what's the strongest part of the investment case? We've seen a lot of retail participation, particularly in leverage type products, and some of that also has come back down. So what's going to be the drivers going forward for gold?
So Ford has liked gold as an asset class over a long time for its diversification potential, inflation hedge, and I think in recent years the market has come to appreciate its value in a portfolio. Now, obviously, when we got to $5,500 and platinum was rallying, silver was rallying, there was a lot of speculative activity, and what you saw was an unwind from quite elevated levels, which is not totally unexpected. We've seen central banks for net sellers of gold in recent months. Turkey, for example, sold their entire gold reserves to prop up their currency. So when you have a war and the oil price is spiking, these type of liquidity events can happen. On the right-hand side, you've got a chart of ETF holdings of gold. You've seen that pull back. So there was speculative activity in gold, not at the highs that we saw in 2022, but we saw a good inflows and investor participation in gold, and that's kind of pulled back. And our view is that it has washed out some of the excess froth in the gold market, and at $4,000 we are very optimistic on the price for two primary reasons. Geopolitics, we're in the midst of hot wars, Middle East, Ukraine, cold wars, trade wars. Geopolitical shifts mean that the US dollar is not going to be the global reserve asset going forward. So we think that the gold has a good chance of assuming a much bigger role in the financial system. And then secondly, the fiscal situation globally is out of control. The US is still running a $2 trillion deficit. They're about to hit $40 trillion of debt. They hit 30 trillion in 2022. It's not much, 4 years later, they're already at 40 trillion. So all over the world, massive deficits, massive debt problems, and that's good for gold longer term.
And there's no signs of that abating anytime in the short term. Okay. I want to move now to sort of the offshore portion of the portfolio, because that's been a big allocation within the fund. Tech stocks have had a good run, especially anything related to AI, as you know. If you compare sort of some of the fund holdings, Tencent, Alibaba, JD.com, to some of the market favorites from the US, for instance, where do you see the big disconnect between valuation and fundamentals between the two?
So our belief is over the long term, price does follow earnings. So valuations do matter, but we're in a market at the moment where valuations are being ignored, and it's more about the narrative. And I think SpaceX listing in the last month just shows you a company hitting 4 trillion valuation very briefly, but on very little fundamentals in terms of sales and its competitive position in the market. So that gives you an idea of where we are. Now, if we compare the valuations in the US of the tech majors, for example, and compare that relative to China, you're seeing price to sales levels of 10, 11, price to free cash flows of 200 in the US. You compare that to some of the Chinese tech giants, which are at the forefront of technology as well, price to sales of less than 3, price to free cash flow of 13 times, and you're getting these with very similar type of growth levels. So we think there's a big valuation disconnect, and that's only opened up over the course of this year. The tech giants in the US are up around 10%. Chinese tech giants are down 17%. So that valuation differential has opened up further. But we're already seeing this unwind. Some of the news in the last few weeks, Kimi, Moonshot AI releasing a model which is almost on par with what Anthropic's Fable, which was almost like a weapon of mass destruction. And they've almost matched it with an open source model. They're about to list at something like a $30 billion valuation. Whereas you've got Anthropic and OpenAI talking about $1 trillion valuation. So the disconnect is just way too big, and we think that over the next 6 to 12 months and into next year, these type of differentials are going to narrow, and it is going to come out in the wash, and we're already seeing that over the course of this month.
So even if you have just any sort of form of mean reversion there, there's good upside in these holdings. Of course, this being a low equity fund, we cannot speak about the fixed income. You've increased SA equities and inflation-linked bonds. You've been a big back of inflation-linked bonds while reducing fixed-rate bonds. What's changed the opportunity set for you, and what drove those decisions?
Yeah, so the last year we saw a big rally in nominal bonds, and the gap between nominals and inflation is called the break-even. That narrowed very significantly, and it narrowed to the extent that the market had basically priced in the achievement of the new inflation target. And our view at that point was definitely that inflation risk, the structural inflation in SA would not necessarily be at 3%. Ours was more towards 4.5%. I think the market is beginning to appreciate that, but where we can lock in real yields of 4% on inflation-linked bonds, we're happy to have that big allocation. And that's why you've seen that consistent tilt, such that now we overwhelmingly in favor of inflation-linked bonds.
Okay. And what can you tell us about the fund's positioning in terms of asset allocation? What does that tell you about your view going forward?
So I think we're very happy with the fund's positioning from both a diversification and a return perspective. If you look at the allocation across the range of equity markets, global equities are heavily dominated from the US. We prefer a more broader allocation. We've got SA equity, Asian, European, as well as US. And in fact, we've been trimming back on the US over the course of this year, and the speculative activity that I've described before is one of the big reasons for that. On the fixed income side, we've been tilting, as I mentioned, more in favor of inflation linkers, and we do have a decent level of money market positioning. And on the offshore side, we're also finding value in TIPS, which is US inflation linked bonds. Very little duration. We see risks in long bonds. And then foreign money market, we also have a decent amount there in money market assets at decent yields, because your US yields are at decent levels, but it also gives us that optionality. And then gold, still a significant portion. As I think, the fact that it's pulled back creates a nice opportunity, and we are happy with that allocation. So from a diversification perspective, we're very happy with the holdings of the fund. On the return side, the SA equity holding, the Chinese equity holding, we think that gives great return potential. The inflation-linked bonds linkers have great return potential. So from a return potential, we're excited about the fund. And then I think optionality as well. If you look at the current structure of the market and the level of froth and overvaluation, it's nice to have some optionality. So if you look at our money market position in the SA, 7%, foreign money market, 12%, it gives us great opportunity. If you have to get a sell-off, we are able to buy into risk assets and maybe some opportunities in credit which might appear in the second half of the year.
Thanks, Rashaad. Maybe just to end of all the themes in your portfolio, where do you see the biggest gap between market expectations and what's currently playing out in reality?
I think we mentioned the froth in the US and tech valuations. I think that when you see an example of Chinese open source models catching up so rapidly within a month of the frontier models, and the gap in valuation that you're seeing there, valued at 30 times what the US is, I think there is a massive gap between expectation and reality. That's one area, and we think that produces some downside risk to the market, which we can take advantage of in a sell-off. And then I would say in South Africa, we've talked about inflation, the market thinking 3% is a done deal. Even before the war, we thought that was highly optimistic. And now that you've got a lot of inflationary pressure coming through with supply chains, with oil, and refining margins, it's not only the oil price which is higher, refining margins are at record highs. There's a lot of constraints on the economy from energy and chemicals. And we think that the upward inflation pressure is likely to last over the next 18 months.
Thanks, Rashaad. We'll leave it there for now. We certainly enjoyed your insights. We look forward to how the rest of the year plays out for you and the team and the Stable Fund.
Thanks.